Every year, Americans make $1 trillion in insurance mistakes. They overpay for coverage they don't need, underpay for protection that would save their family, and the insurance industry is counting on that confusion. Today, I am going to change that. Welcome to Insure Smart. Let's start with what almost nobody tells you. Insurance at its core is a mathematical bet. You bet the insurance company that something bad will happen. They bet it won't. The winner keeps the money. But here's the thing. Insurance companies are not charities. They are extremely profitable businesses that have spent decades studying exactly how to price those bets to stay ahead of you. In 2022, the US life insurance industry alone collected over $900 billion in premiums. The amount they paid out? About 60 cents on every dollar. That gap, the 40 cents they kept, is not evil. It pays for their risk, their operations, and yes, their profits. But knowing that gap exists changes how you should think about buying coverage. The smartest insurance buyers don't think of insurance as an investment. They think of it as a transfer of risk. And they only transfer the risks they genuinely cannot afford to absorb themselves. Life insurance is the most misunderstood financial product in America. Most people own the wrong kind, in the wrong amount, for the wrong reasons. Let us clear up the biggest myth. Whole life insurance is not an investment. The returns are historically 1 to 2% after fees, worse than a savings account. The real purpose of life insurance is simple: to replace your income if you die and someone is depending on you. That means if nobody depends on your income, no spouse, no children, no mortgage, you may not need life insurance at all. But if you do have dependents, the only question that matters is, how much do they need and for how long? Here's the formula the insurance industry does not advertise. Take your annual income and multiply it by 10. Then add your mortgage payoff, your debts, and an estimate of college costs for each child. That total number is your coverage target. For most American families, that number is between $500,000 and $1.5 million. And the cheapest way to get there? A 20-year term life policy costs the average 35-year-old non-smoker about $30 per month for $500,000 in coverage. That is not much. That is the cost of one dinner out. Yet only 40% of Americans have any term coverage at all. Health insurance is where most people's money goes wrong. And it is because they do not understand what they are actually buying. When you look at a health plan, you see a premium, the monthly payment. But that is only part of the cost. Every health plan also has a deductible, co-pays, co-insurance, and an out-of-pocket maximum. Together, these numbers tell you the real cost of getting sick. Here is what matters. If you are healthy and rarely use medical care, you want a high deductible plan with a low premium, and you want to pair it with a health savings account, or HSA. The HSA lets you put pre-tax money aside for medical expenses. That means you are getting a tax deduction on money you are going to spend anyway. But if you manage a chronic condition, diabetes, high blood pressure, or anything requiring regular specialist visits, a low deductible plan often saves more money even though the premium is higher, because your actual medical costs will regularly hit that deductible. The mistake most people make? They pick the plan with the lowest monthly premium and assume they're saving money. Then they get a $6,000 deductible bill and realize the math never worked in their favor. Before open enrollment, run the numbers. Estimate your annual medical spending, model 2 or 3 plans, and choose based on total expected cost, not just the sticker price. Auto insurance is the most regulated and competitive insurance market in America, which means there is actually real money to save if you know what you are doing. Your policy has 2 main buckets: liability coverage, what pays when you hurt someone else, and first-party coverage, which includes collision and comprehensive, covering damage to your own car. Here is what most people get wrong. They carry expensive collision coverage on a car worth less than $5,000. If your car is worth $4,000 and your deductible is $1,000, your insurance company will pay out a maximum of $3,000 if you total it. Is it worth $800 a year in premiums for that? Almost never. The other lever you control is your deductible. Every $500 you raise your deductible, typically lowers your annual premium by 10 to 15%. If you have an emergency fund that can cover a $1,000 or $2,000 repair, raising your deductible and pocketing the savings is almost always the right financial move. And the most underused discount in auto insurance? Bundling. Combining auto and home or renter's insurance with one carrier typically saves between 10 and 25% on both policies. That is free money most people leave on the table. Now that you understand each type of coverage, let us talk about how to build a complete protection strategy. Because insurance is not about buying every product. It is about covering the risks that could actually devastate you. Start with the catastrophic risks first. These are the ones that could wipe you out financially. Death if people depend on your income, a major medical event, liability from a serious auto accident. These are the ones you must insure. Next, look at your income risk. If you became disabled and could not work, how long could you cover your expenses? Most employers offer short-term disability, but fewer than 35% of American workers have long-term disability coverage, even though you are statistically far more likely to become disabled before age 65 than to die before age 65. Finally, look at your property. Do you own your home? Homeowner's insurance is non-negotiable if you have a mortgage, and even without one, a catastrophic loss without coverage is financially devastating. The guideline I would suggest: aim to spend no more than 10 to 20% of your income on insurance total. If you are spending more, you are likely overinsured somewhere. If you are spending less, audit what you are actually covered for. Here are the 3 things that will change how you buy insurance from today forward. Number 1. Insurance is risk transfer, not an investment. Never confuse the two. Number 2. Life and disability insurance exists to protect people who depend on your income. If no one depends on you, you may need far less than you think. If someone does, you almost certainly need far more. And number 3, in health and auto, the details, the deductible, the out-of-pocket maximum, the bundling discount matter more than the monthly premium you see first. The insurance industry is a $1.5 trillion business built on the assumption that you will not read the fine print. This channel is dedicated to changing that. If this video helped you think about insurance differently, subscribe to Insure Smart. Every week we break down a financial system that most people accept without ever understanding. Hit that subscribe button, and we'll see you in the next one.